Hi, my name is Michael Brewitt, the owner of Brewitt Financial, and today we're on the Smiths' beautiful farm outside of Waterford, Ontario. Today's topic in our ongoing learning session covers estate freezes, what they are, and how they work. It's not used often, but it could be the right strategy to help you with a smooth succession plan. So what is an estate freeze? Well, an estate freeze is a legal and financial strategy often used in succession planning for family-owned businesses or farms in Ontario. It involves freezing the value of the farm or business at its current market value so that future growth benefits the next generation. Let me explain in a little more detail. The objective of an estate freeze is to limit the capital gains the current owner would owe if they sold or passed away and transferred the farm. It allows the future value increases to benefit the next generation, increasing their net worth and reducing the tax burden on the parent's estate. Now you may ask, how does it work? What are the steps in the process? The first thing to do is to determine the fair market value of the farm. A professional appraiser will determine that fair market value, which includes land, building, equipment, and any other associated businesses. Next, you'll need to create a holding company, or optionally, a family trust. The holding company or family trust is set up to manage the ownership transition and future value distribution. A trust is ideal if the children are minors. Then you will need to exchange ownership for fixed value shares. The current owner or the parents transfer the farm to the corporation in exchange for preferred shares equal to the farm's current value. These shares have a fixed value and do not increase, essentially freezing the owner's estate value. The corporation now owns the farm. Finally, you'll need to issue growth shares. The corporation issues new common shares to the children or the family trust, and any future increases in the value of the farm is reflected in these shares, effectively transferring growth potential to the next generation. So why does it usually make more sense to use a corporation? Well, a corporation allows for the separation of the farm's frozen value or preferred shares from its future growth or common shares. It also simplifies tax deferral and estate distribution. So what are the overall tax implications? There are three to consider. Number one, the capital gains tax. The parents do not pay immediate capital gains tax because the transfer to the corporation typically occurs on a tax-deferred basis under the Income Tax Act, and the frozen value of the preferred shares will eventually be taxed when sold or transferred upon death. Number two, the lifetime capital gains exemption. Ontario farmers can use their lifetime capital gains exemption for up to $1 million to offset taxes on the farm transfer. This reduces or eliminates the tax on the frozen value. And number three, future taxes on common shares. The children or the trust will pay taxes on future gains when they sell or inherit the common shares. So why should you consider this strategy? We pay a lot of taxes in Ontario, and anything we can do to minimize that means more money in our pockets. An estate freeze helps to minimize taxation on the parent's estate. It also helps to make the transition to the new owners much smoother. Finally, it allows the parents to also retain control by holding the voting shares while transferring non-voting common shares. As with any strategy, there are some risks and considerations to be aware of. Number one, valuation disputes. A low fair market value may trigger scrutiny from the Canada Revenue Agency or other potential heirs. Number two, liquidity needs. You'll need to ensure that the farm can generate enough income to pay any future taxes. Three, costs. Legal fees, accounting services, and appraisal are not free. Be aware that it will take some upfront capital to put this strategy in place. Number four, fairness. It's more and more common that not all kids want to continue the farming tradition. Be sure to plan for equitable treatment of children if some are not involved in the farm. Finally, I want to give you a quick example, although it's always best to scrutinize the intricate pieces of each farmer's plan. This example is simply to demonstrate how it works. So let's say Bill and Nancy's farm is worth $2 million today, and the parents believe it will grow to $5 million over time. Using an estate freeze, the parents would transfer the farm to a corporation in exchange for preferred shares valued at $2 million, and the children or family trust would receive common shares capturing the future $3 million of growth. The parents retain control and can receive income from the preferred shares via dividends, and this transfer is typically done on a tax-deferred basis, meaning that no immediate capital gains taxes are triggered because the transaction qualifies under the rollover provision of the Income Tax Act. As well, the parents' adjusted cost base, or the original purchase price plus improvements, of the farm is carried over to the preferred shares. The result is no taxes paid now unless the parents choose to trigger the gains intentionally. When the parents eventually sell or pass away, the preferred shares valued at $2 million will be taxed through the estate. And if the farm qualifies as a family farm property, then the parents can use their exemption of up to $1 million per person to offset the capital gain. And in this case, if both parents own the farm and the gain can be split, then no tax would be payable on the preferred shares. To conclude, an estate freeze helps farmers in Ontario plan for the future by minimizing their tax burdens and smoothly transitioning ownership. If you would like to explore if this strategy might be a good fit for you and your plan, then don't hesitate to reach out to Brood Financial, and we would be happy to explore scenarios with you. Always remember, it doesn't cost you to ask us a question, but the information you receive may be invaluable.